Hey, welcome. This is Don Kryptonium, and today we are going to discuss a hyper-financialization of the markets. Because we had a Michael Saylor, and it might sound ridiculous for you, right? You go and you hear Michael Saylor go up on the TV, and he says in 21 years, Bitcoin at $13 million. And you think, that's crazy. I just want 300,000. And this is why today we are trying to talk about this hyper-financialization of the market. Is it possible? And how these compounding rates work. So before we start, you make sure you like, love, share, comment, and displays the commitment to the Kryptonium. Okay, because I was looking into the markets, and we live in very interesting time right now. Okay, because it's really difficult times, and when you look at the stocks, you will realize that, because the Ray Dalio and many others, they tell you the cash is trash. You must buy the assets, right? So think of it this way. We live in the constant state of the drying liquidity, right? And that also relates to the crypto, right? The hype starts and you deploy the capital, and then your capital is dry. And that happens in the stock markets as well, right? The Fed steps in, introduces a loose monetary policy, and interest rates going lower, and what the wealthy class is doing, right? What the wealthy class receiving a boost of liquidity are doing. They take the liquidity and they buy an Nvidia stock, they buy the Apple stock, they buy the Google stock. That's called Alphabet, right? They buy the Microsoft. They go to Japan, and in Japan, they take the loan. What's the interest rate in Japan now? They raised that. It's 0.25%, right? Sorry. So, imagine you wealthy class of Japan, okay? You wealthy class of Japan, and you take the loan, okay? You take whatever yen it takes to have $50 million. And what you do? And you go, because it's open market, and you buy the stock, and you buy again Apple, you buy Nvidia, and you buy yourself a Bitcoin too. Because why? Because your interest rate, 0.25, Japanese yen, historically perhaps, maybe not anymore, but it would underperform. And imagine that. The yen go down, your assets are in US dollar, your assets then are worth much more in Japanese yen, accounting books look much better. Right? So this is the hyper-financialization, the constant drying the liquidity. A loop, I would say, this is the, how to call it, a quiet desperation, because there is no dream of remaining liquidity. There is just the dream of constant boost of liquidity and pump of the assets. And I don't think anyone knows how to really escape that, because we are talking about rates being lowered very soon, and the reason why we want that, it's not to liquefy the businesses, it's not to take the productive loan from the bank and what would be in demand now? Hotels, maybe not hotels because the populations of the people. But okay, let's do this. It's not for the purpose of of taking a loan and opening a, beautiful safari hotel in Botswana. It's not for that. It's not the loan for what could be productive again. Well, you see, it's difficult. I'm not smart. Not many business ideas. What else would be? We could say a midget restaurant in Dubai, but we know there is already it's in high demand. There is a lot of not in high demand, in a high supply. Wherever you go to Middle East, you have midgets serving you cakes. So that's not great, right? Maybe a kettle for the rising demand of the steak. But it's really also the very fierce competition. But what I'm trying to say, that's the productive. But it's not for that. It's not that you want to open a bakery in the land where you have healthy demographic and many people consuming bread, so there is high demand. It's not for that. The lower interest rates essentially means we are gonna buy more assets. We don't want money. Ray Dalio said, cash is trash. So what we do, we buy the assets and then we go to the bank and say, loan against my assets, a hyper-financialization. Okay? It's also very interesting because, so we have this crazy illogical panic on the market. We have crazy news. We had the news. People say on the TV. I listen to the TV and people say, Nvidia, the worst day in years. The drop of 10%. Was it actually 10%? Yeah. So they say Nvidia nuked 10% at $300 billion evaporated from the. And you listen, $300 million. People sold $300 million stock. No, it doesn't work like this. Hyper-financialization of the assets, right? The prices, in this case, are based on the order books that you have. How much was the sell-off? We don't know. I'm not going to tell you if it was 10 billion or 30 billion, but of course the order book go down, so the market cap goes down. But it doesn't mean that there was a $300 billion of liquidity wiped out. It was just a market cap, right? A correction. And everyone says, worst day, a tragedy happens. Like we almost as presented like by the deep. But when you look at that hyper-financialization of the market, yeah, Nvidia did, in fact, in last 5 years, it did more than 2,000%. And it's crazy to think because that's a compound rate, a yearly compound rate of I think nearly like 100%. We can actually calculate that because I opened the website here, right? Let's say you put $1,000 into Nvidia 5 years ago, no monthly contribution, 5 years, estimated interest. Let's do 80. I think it's something around that. Would it be that? That's almost that. So that would be more. Let's do 85. Calculate. Something between there, right? I think around 85% in Nvidia compound interest rate. And then there is Michael Saylor going and speaking of Bitcoin that in 21 years it's going to be $13 million. And I think that's a crazy number. That's insane number because it means that's like more than 200x, right? In 21 years. But that's actually not as crazy number if you consider that hyper-financialization and compound rate, right? Nvidia outperformed Bitcoin in the last 5 years because cash is trash. inject liquidity. So actually you have this which is very interesting, because you have this cloud of like really large caps, but it doesn't mean that like you can extract as much money. But it's very interesting. I have no idea where it would lead, right? But it's very interesting. A credit system. Because it makes much more sense to buy the hyper-financialized asset and take a credit against that, right? You can squeeze more money out of this. But where it leads? A cheap money, hyper-financialization of the assets. Okay? Let's see at the compound rate of Michael Saylor was saying. So now we have like $55,000. I'm gonna round it up. That's like over 200x. Let's round it up to 200x. What we need to do in 21 years to pull 200x, right? So the time is 21 years. Could be rounded to 20s, whatever. And let's say Bitcoin performs 25% a year, and the compound. I'm doing compound because it's like performance on the yearly basis, which is interesting. Like the S&P, actually, what's the S&P doing? Like over 10%. So if that would be doing 25 from now, you do 100x. So I'm doing from now because Michael Saylor said maybe next year's will be like 40%, then like 35, and finally settle at like 20, S&P plus premium, because he said the total capital of the worth is 0.1% allocated in Bitcoin, and he expects that will go to 7%, which I believe he actually compares that to gold. And many people says gold might be undervalued, but when you think of it, gold is already at like $17 trillion. Hyper-financialization of the assets. And Bitcoin is at what? 1 trillion. Okay? So this is what I'm trying to tell to you, that this could be possible. If that hyper-financialization of the asset happens, what are the opportunities in the other areas like a meme coin, like a layer ones? Many layer ones, of course, is gonna underperform that performance of Bitcoin, but perhaps there will be a cultural and financial instruments that are able to overperform that assets. And this is why the Wall Street is actually selling you that, because that's why BlackRock must be bullish on Bitcoin. Okay, why they must be bullish on Bitcoin? Because you can go to any of these companies, and they will try to sell you something. They could sell you great performing, guaranteed compound rate of 5%. You pay for, let's say, 5 years, and you are break even on the year 6. In the year that already they doubled your money, so they already make half money. It's not in the case of Bitcoin ETF, but maybe in someday they will introduce you this the saving plan in which they include those assets, right? And you think, great, every year I'm gonna make 5% of the cash at some point, maybe even 7%. They would say maybe it will overperform to 9%, but maybe that was interesting in the 90s, because as we live in that hyper-financialization of the assets, what is that? S&P 10.5% in like past 10 years. Nvidia, if we go further, let's go 10 years of Nvidia. Are we serious? Nvidia in the 10 years is like 200x, yeah? Shit. So Nvidia in past 10 years pulled what Michael Saylor predicts a Bitcoin to pull in the next 21 years. That shows you the power of the financialization. So that's 10 years of Nvidia, okay? Of course, S&P was less and so on. So what I'm trying to say, whether you try to save money on the interest rates or buying treasuries, buying saving or investment plans, you will underperform the market because of that hyper-financialization of the assets. The low interest rates don't appear to do anything. They don't appear to boost economy. But the low interest rates, beyond anything, they boost the asset prices. Because the debt that's created doesn't land into certain productive assets, but it lands into mindshare of cash is trash. And with that, don't cryptonims out. Till the next time.